JJ the CPA here, coming to you from Fort Collins, Colorado. Just finishing up talking to a great group of CPAs. We're talking about year-end tax planning. There's the thing. When the year's over, it's over. You need to determine now if you're going to push income, if you're going to pull it, if you're going to push expense, or you're going to pull expense into this year. You need to be taking a look at what did you do at the end of last year, because you might need to do the exact same thing at the end of this year, just so that all things are equal. There's a new tax law provisions in play. So if you're a business that's over 25 million, you've got some new rules as it relates to interest deduction. But if you're under 25 million, you've got some great rules that have come into play in this new tax law. Basically, if you're under 25 million, you can be a cash basis. If you've been accrual and you're under 25 million, used to be a $10 million threshold, you can move to cash basis. If you're under 25 million gross receipts, and this is the average over a 3-year period, you don't have to account for inventory. You don't have to do 263 calculation, which is a way to add cost to inventory. You don't have to do that anymore. If you're a small contractor and most of your contracts are going to be done or complete within 2 years, you don't have to do the percentage of completion or the WIP anymore. You're just able to write off the expenses. So as it relates to inventory, you can just write it off as expense, just as material incidental, boom, write it off. You don't have to track inventory at year end for federal income tax purposes. There's some provisions around that, right? Then from the standpoint of cash basis, well, cash basis is always going to be typically better than accrual, because you don't recognize the income till you collect it, and you get to write off the expense when you pay it. Now, for small businesses that we've been working with, other than maybe one or two, your cash basis. So here's what you need to know. When you get to year end, what is it that you're going to pay in January? At least pay that before year end. Rule of thumb here is reduce down your income as much as you can for 2018. Then pushing income into next year. As you get closer to the end of the year, basically this becomes easier for you. Okay, we're not talking about taking checks and cash and putting it in the drawer. If you receive it, it's taxable. We're talking about if you were to delay invoicing clients, or delay just slightly when you're putting in your insurance claims, let's say if you're a doctor. So if you're doing those things, then you can be in a situation where you collect the income next year. So know this, when you're cash basis, you can pay up to 12 months of expenses in advance, and as long as you use that up within 12 months, you can write it off when you pay it. Such thing as rent or health insurance or advertising. We do that all the time, right? Think of just your insurance on your business. You're always prepaying that. You're never paying in arrears. You're always prepaying it. And when you pay it, that's when you get to deduct it. So be smart when you get to year end. Focus in. I know you may be busy, you're running your business, you got holidays or whatever, but focus in, because what you do now is going to save you next April. All right. Hey, thanks for tuning in. If you're watching this, please subscribe. That's all I ask. And then don't you ever forget, you've never met a CPA quite like me. Don't you ever forget, you've never met a CPA quite like me.